Welcome to the online lecture for Chapter 1, Managing Revenue and Expenses. In this chapter, we're going to cover several topics. We're going to talk about how and why managing revenue is so important in any food service operation. We will also cover many topics, as you can see on the screen today. In our Tuesday lecture, we discussed why the food service manager is different than any other manager. We talked to how this differs from, let's say, a retail manager. We talked about the fact that a food service manager really has so many more tasks than any other manager that you can possibly think about. We talked about the fact that we really have to manage anything in our organizations from the inception, meaning we think about what we're going to be making, we think about the concept, we design it, we really think about the details, and then we have to go out and secure the raw goods, the actual ingredients, right? Seek out vendors. Where are we going to buy our items from? We have to train our people. We have to then bring these raw goods in, and then we have to train our people to actually make them, right, to manufacture them per se, and then we have to have our salespeople or our servers or bartenders or whomever it is that's actually selling and dealing with the customers. And there's the customer service aspect. Then we have to ensure that the people that are purchasing the items actually pay for it and that actually they want to purchase our products, right? And then in the end, we actually have to we have to make sure that if there's a problem, we actually deal with it. So those are really very unique things to any other type of manager. We also discussed why low costs are not always good and why sometimes they are good, and why high costs are not always bad because sometimes high costs are necessary, such as I believe I spoke about when it comes to safety and security. High costs, those things come with a price and you have to pay them because safety and security for your staff and for your employees and for your customers is really important. So those are things that we absolutely cannot skimp on. Now, low costs, are they always good? Not necessarily. Not if you're buying a product that is not good, meaning it's expired or it's just the quality is not great, right? So those things are something that we really have to keep in mind. So we always have to kind of balance this. This is this balance of a manager, and this is why this is so important. We need to make sure that, yes, while we manage costs, that is important, but we never sacrifice either the quality or the integrity or the security and safety of our staff and of our business, right? And our customers, of course, as well. So that's something that we need to make sure that whatever cost-cutting measures we have, it actually does not impact the guest, right? Or our staff. All right, so this is kind of just a flow chart of how cash moves through a business, right? So obviously we have to start off in any business with some sort of cash reserves in order to purchase products that we're actually going to produce and then hopefully sell, right? So we have these cash reserves, we make purchases for, our raw materials, and then we also have to pay our staff. Hopefully we produce something like a finished product. So in our example, if we're doing a food service product, let's say we're making pizzas, we have to purchase everything to make the pizzas, then we have to pay the people to make the pizzas, then we have a finished product that we hopefully sell to our customers, and then hopefully that we receive another cash income from selling the pizzas that should pay for our supplies, our purchases, and then hopefully that will go back into our cash reserves. And that's kind of this flow that we're trying to actually, secure in any business that we have, and essentially, hopefully, making some sort of profit, right? So that's kind of what we're looking for, is to make a profit. Now, if we don't make a profit, we're obviously going to incur a loss. But the way that you look at that is you look at what you generate in revenue. Revenue is typically the amount of dollars that you take in. Some people will look at this as sales, right? So revenue. Revenue minus expenses. Expenses are the cost of items and the people required to operate your business. And then hopefully you will generate, like I said, either a profit or you may have a loss. We use revenue and sales interchangeably and expenses and costs interchangeably. So just be careful. There's just one, there's certain areas just with verbiage that we have that we kind of go back and forth, and you'll see that later on, especially as we're reading a profit and loss statement. So obviously profit is something that we are trying to gain. And I even described, or I even spoke about the fact that yes, we do have nonprofit organizations, but even nonprofit organizations, while their goal is not to achieve a profit, to make a profit, they take that profit and then put it back into whatever organization for that cause, right? So that's something that if you're thinking like a nonprofit organization like the Red Cross, right? Red Cross is not there to make a profit, make people within the Red Cross rich, but the more money that it generates and the more good it can do. So there you are. Definitely profit is a result of planning, of management, and definitely a decision making. That's ultimately what managers do, is we have to make decisions. So here is a kind of this thing that people or customers don't really think about, right? They always think about that restaurants must be making so much money because a bottle of water costs a certain amount and you sell it for a certain amount. So you have to you look at the giant profit that you're making, right? And the truth is that that's not really the case. I mean, if you're looking at something like in this example, the cost of Allen Brothers Prime New York strip, right? So to actually buy it and purchase it and bring it into the building actually costs me as a restaurant around close to $40 a piece just for one steak, right? There's probably many of you looking at this being like, wow, I wouldn't even really pay $39.75 or $40 for a steak. That's very, very expensive. Well, if you want to be selling prime beef, which is what this is, right? So it's the best type of beef. That's actually what it costs for me to have it, to actually buy it from my vendor. Even if I put it on the menu price at $52, that's still, very cheap, because that's compared to what it cost us. And that's kind of a big price. Once again, not everybody would pay that. And that would only generate $12.25 in what may seem like our profit, but is it really, right? Is that our profit? And the answer is no, because profit is the amount of dollars that remain after all expenses have been paid. And essentially, no expenses have been paid at this point. I've only paid the person that's brought in my New York strip, right? So that's absolutely not. So what we have to do is we have to understand, how do we get a desired profit? And can we budget for a profit, right? Can we budget for something that we want to make? And the answer is yes. I mean, you can budget. This is the power that we have as managers. You absolutely can budget for anything. It's really important actually to keep in mind a desired profit. How much money do I want to make, or do I need to make, right? Those are two very important questions that we have to ask. And really, the only answer you can get is if you know your costs at all times. And literally, because costs fluctuate all the time, you have to constantly know as a food service manager how much and what your costs are in everything that you have within your organization. So when we're looking at these profit margins and looking at these formulas, right? We have to understand what a desired profit is, right? And what a desired profit is, it's something that we want to achieve and we need to achieve in order to sustain our business. So this is kind of what we're looking at. So if you're looking at a revenue, right? And then you want to predict a specific revenue, and we'll talk about budgeting for a revenue, right? I think that I will have 100 customers come in during today's day, right? So today's a Thursday. So Thursday, I'll have 100 customers come in. Each customer will spend $100, and that is going to be my my budgeted revenue, right? Now, that's not that could be wishful thinking, but hopefully that is done on a realistic, some sort of realistic numbers. But essentially, you could do that. So you would say, I would have this desired revenue. Or budgeted revenue, I have a desired profit, so then I have an ideal expense. And you can look at this and say, is this realistic? Can I get the product that I'm trying to sell for this cost in order to generate this profit, right? So we actually do have control in kind of looking at that and seeing if that's possible. When we're looking at revenue, right? Revenue is a little bit different because revenue can be a couple of different, we can look at it in a couple of different ways. Not necessarily always in dollars, which is what most people think. Sometimes we look at revenue as units sold. So we can look at that as number of entrees, alcoholic beverages, whatever it may be. And obviously that will vary with the number of guests served and obviously the amount of money spent by each guest. Typically we call in the restaurant business what somebody spends, it's their average guest check, right? So that's per person. What do they spend? So if you hear something like, what is your average guest check? That means the average amount of money that an individual spends. And that's essentially what we look at. Now, how can you influence revenue? You absolutely can influence revenue. And this is what most managers should be doing, is trying to figure out, how do we increase revenue? And some people think that it's only by volume. Okay, we need to add more chairs and more tables, make our restaurant bigger. And it's not necessarily, it's one way of doing it, but you can actually lose revenue by doing that. And the reason for that is maybe because if you have too many people at once, your kitchen cannot handle it, your food times go up, and then customers aren't happy. And then you're going to have to take things off the bill for them and things like that. So that doesn't always help, right? Not everybody can have a giant restaurant. So you can look at something like increasing the number of guests served. This is actually something that restaurants do all the time. I'm sure many of you guys have heard of happy hour, right? And happy hour is typically during a time when the restaurant is not as busy. So the restaurant is trying to figure out a way to increase the number of people in that restaurant during a slow time. So anytime anybody does any type of specials or things like that, they're trying to increase the number of guests that they're serving. The other one that actually not enough people take care of is the fact that you're trying to increase the number of money. So you're trying to increase the guest check of the guests while they're in your restaurant. And the reason I say people don't do this enough is, they don't really capture the guest enough while they are actually inside of the restaurant. So old term was upselling. We don't really want to use that anymore. We talk about suggestive selling. So people don't suggestive sell enough for an additional drink or for desserts or things like that. And we'll talk about how you can actually do that, but it's definitely not done enough, right? And then obviously the goal is to actually do both, to increase the number of guests and also the amount of money spent by those guests. So there's so many different ways that you can do that. But once again, those are the ways that you should be thinking about doing it. So let's take a look at expenses and what the largest expenses we have in our establishments. Okay, so the largest costs that we have are essentially the top costs that you see. So the food costs, the beverage costs, and then the labor costs. Those are what we call our prime costs. These are the ones that we can have immediate impact over, and also ones that can have an immediate impact on our bottom line, which means either on our profit or our loss. Whether or not I order, 50 cases of Allen Brothers New York prime steaks, or I order 20, that's going to have a giant impact on how much money I have to pay to my vendors. It also has a giant impact on potentially how much money I can make because of how much I charge for those steaks. But also I have to make sure that I sell those steaks. Otherwise, if I don't sell them in time, they can go bad, and there is my loss, right? So those are those are immediate costs that I have impact over as a manager. So anything related to food, your, meats, dairy, fruits, vegetables, anything that is edible comes into this category. Obviously, beverages, when we talk about beverage costs, believe it or not, these actually are considered alcoholic beverage costs in most operations. Non-alcoholic beverage costs actually go under your food costs. So most people, when we talk about beverages and beverage management, it's actually alcoholic beverages. So something like Coca-Cola syrup that goes into your soda machines, that actually is purchased and it's considered actually a food product, if that makes sense. Your labor, this is all your staff. And yes, you do have to pay them. And even though servers will tell you, oh, I make zero money, that's absolutely not true, because we still have to pay them. The fact that they don't see that money because it's eaten up by their taxes does not mean that us as restaurant managers don't have to pay them an hourly wage. We actually have to do that. And then of course our other expenses such as utilities, rent, linen, anything having to do with restaurant operations, we call that department rest stop. And that has to do with everything that is not alive or can be eaten. So those are your plates, your toilet paper, anything like that goes under your rest stop. Okay, good managers, we need to understand and we need to control and we need to manage all of our expenses. And this is something that is actually the reason why you either have a great manager or a terrible manager, because they cannot do all of those things. We